Yo, everybody, back at it once again. Favorite entrepreneur, your boy, official Tyree Samuels. And today we're going to be talking about yet again another successful foreign exchange market setup that was exclusively sent to my Telegram chat. If you guys want to know what it is, what it was, and how it does, make sure y'all stay tuned for the next clip. I'll see you soon. Peace. Yo, everybody, back at it once again. Favorite entrepreneur, your boy, official Tyree Samuels. And once again, as you guys saw in the thumbnail, we're going to be talking about another successful trade, which, as we know, we're not going to win every single one, but whenever we do, we're going to be hype as you know what. Now, before we go any further, make sure y'all go ahead and hit that subscribe button so that YouTube can see that you guys love the videos. And then on top of that, right underneath the subscribe button, you guys are going to see the thumbs up, the like button, and then also go ahead and drop a comment. Now, with that being said, we actually missed out on this trade, okay? So unfortunately, this was not a trade we actually were able to take advantage of, right? I manually exited, and it's a few different scenarios that went into why I did what I did, but I want to be able to break it down because this is a learning lesson. So we didn't lose any money, but we did exit out of the trade before the move was able to be made. But this is a trade that actually took about, it was like 2 weeks, okay? I don't know if you've ever held a trade for 2 weeks. I haven't, but this was an opportunity I could have just held, knowing that it never hit stop loss and I would have actually made money at the end of the day. So learning lesson, right? So first things first, okay? What I want to be able to overall do is I want to initially tell you guys why I even was looking at the setup to begin with. So as usual, I want to be able to give you guys full transparency and show you guys why it is that I took the trade and go back and actually find the original setup. So December 23rd. So what I'm about to do is I'm over here on my other screen. I'm about to go back and find that setup in my Telegram. Because like I said, I want to be able to show you guys the full transparency and show you guys every single trade, how it was sent out to the Telegram, how I personally managed it. Always remember the way that I personally manage my trade. It's recommended that you do the same, but you obviously can do whatever you want to do with the money that you're leveraging on the positions that I call out. So, all right, here we are. All right, ladies and gentlemen, here we are. So first off, if you guys do not have access to my Telegram chat, make sure you follow me on Instagram, right? Which I tagged earlier. It'll be the link in my bio. And then also at literally every single YouTube video that I drop in the description, you're going to see my Telegram link. Okay. So make sure y'all go ahead and tap into that. Now, sell limit, Audchf, right? Entry, SL, TP1, TP2, TP3. This is exactly what the original setup looked like at the time that I called out the trade. Okay. So what I want to be able to show you guys is, basically why we ended up manually exiting. So I'm actually show you. Give me 1 second. All right, manual exit at break even. Every single AUD pair has been bullish all week. We'll rather play it safe. Normally, we wouldn't have manually closed. Reason why I said all that is because I personally don't manual exit for specific reasons, because I used to be one of the hardest things. I had a issue with breaking that cycle. So I just hold every trade. Even if it looks bad, I'm gonna just hold it. Normally we wouldn't have manually closed, but since we are in the week of Christmas, right? I forgot to mention the market can move very different. We at least close at break even and not at a loss, which is the main goal. See you guys next week. So all in all, the only reason why I actually went forward with manually closing is because, it was Christmas. If this was just another week, I would have just ended up holding it. But, one thing I did learn is I now have formed so much confidence that I can't allow anything to change my rules. My rule is to never manual exit. Now I know a holiday, a news event, I'm never going to manual exit a trade ever again. It's just going to hit stop loss, or it's going to go into profit and maybe hit my break even. Okay. Now, with that being said, the thing, the thing that I always tell you guys whenever you get on these calls is the time frame that I like using the most, which is the 1 hour time frame, right? So on a 1 hour time frame, what I always like to be able to identify is what is the overall trend of the market. So as you guys can clearly see, right, the market created this high up here, right? And then from this high, the market obviously gave a very aggressive drop to the downside, 511 pips to be exact. So from this peak, it was October 26th down to this low was about December something. So as you guys can see, this is over the course of 37 days and 22 hours. So about a month, like a month and a week, right? So over a month, this market has been aggressively bearish, right? So I can identify obviously that this is a downtrend. So a couple of different ways, depending on who's actually looking at this chart. You might interpret this might now start being an uptrend, but what I see is essentially a retracement, right, within the overall bearish move. Even though it is temporarily bullish, this is technically sentiment-wise, this is going to be a retracement within the overall bearish move, right? So I like to initially figure out what the trend is, right? And then from there, I need to be able to look at some other information to identify, am I going to trade with the trend or am I going to take a counter trend trade? What do I utilize to be able to take advantage of that, right? One of the tools I like to utilize is going to be the RSI. Okay, guys, the RSI. Now, with the RSI, what I like to do is I like to look for two different confirmations, right? I want to be able to look for weakening in the market, right? The trend weakening. And I also want to be able to possibly see if I can spot any type of divergence. So whenever I say weakening in the market, the dope thing about this indicator is this white line is going to represent following the actual price above. Now, it's not always going to be exact, but whenever it is not the same, that's whenever you can possibly start predicting that there might be a momentum shift. So whenever you can identify that the momentum is becoming weak, okay, is whenever you see this white line, right, peak outside of that purple box. If it peaks out to the upside, that means the upward or buying momentum is becoming weak. If it happens to the downside, that means that the downside or selling momentum is becoming weak. Now, the reason why you want to know if it's becoming weak is because that gives you the opportunity to be able to see, start gauging and getting ready to possibly take a potential reversal or potential counter trend trade, right? So, the concept of basically what I want to be able to show you guys is how to be able to take advantage of this information. So notice how the market, right, spiked out. It showed right here, okay, that this high was showing that the market was steadily becoming weaker, but you don't just want to hurry up and jump in whenever the market is saying, hey, we're getting weaker. What you want to do is you want to be patient, you want to wait, and you want to be able to see if there are additional confirmations that you can take advantage of, right? So whenever I saw this initially happen, I'm not just going to randomly hop in for a sell, but now I can start looking to see if there's any kind of identifying factors that can show me that the market is going to gradually become weaker and weaker. So the market kept going up, gave a very weak retracement, and then pops back up. Now notice, once it popped back up, once again, we had another indication that the upward momentum is becoming weaker. What did the market actually do? It then finally gave a very aggressive downside sell-off, okay? So from this initial sell-off, right, we don't actually have divergence, so there's no reason for me to even go into that and look for it. So from this initial sell-off, right, if I were to, let me actually remove, give me 1 second. Let me use the replay tool, which by the way, guys, if you guys actually don't know how to properly utilize the replay tool, I'm actually going to drop a YouTube link up in the top right corner. I actually have a YouTube video explaining how to properly use the replay tool. Okay. So if I utilize the replay tool, this is what the market would have looked like at the time I came to the chart. So once I identified the overall trend, I was seeing the momentum getting weaker somewhere in this range. I saw this peak happen, right here, to where the momentum, actually, I take that back. We actually do have divergence. So let me go ahead and throw up here as well. So I also have a YouTube video showing you guys how to be able to properly identify divergence. Okay. So what is divergence, right? Divergence is pretty straightforward. It does take some time to be able to identify. So remember how I said this line is basically going to be imitating price above. Whenever you see that price above and the indicator below are doing two completely different things, one is going in one direction, the other is going in another, that potentially can be divergence. Divergence is a very good indicator for market reversals, right? So if I go to the candle chart and change it to a line chart, it'll be a lot easier to see. So if I also go ahead, take a vertical line, like how you guys see right here, okay? Go ahead and put another vertical line, like how you guys see right here. If I take the trend line tool, right, and go from here to here, right, what you guys are going to see is this market is obviously trending up, right? But in the same instance, I already marked it. In the same instance, from here to here, the market is obviously trending down. So a lot of times whenever you see divergence, you want to be able to see some sort of, strong impulsive move in the opposite direction. That's kind of like your confirmation that this is a valid divergent move. Okay. So the divergence and the momentum weakening with the RSI peaking outside of the purple zone, those are going to be honestly like my two strongest confirmations to be able to give me the confidence to start moving forward. Okay. So now we're actually going to change it back to the candle chart. And what we can actually start looking for is we can see within this move right here, it's a very strong impulsive move. Now, what we'd like to be able to see is once we get the market showing us a willingness to go in a certain direction, we would like to be able to see some sort of retracement, right? Before we see the continuation. So what I'm about to start doing is I'm about to start looking for my trigger candle, my entry candle, which is an engulfing candle. If you don't know what an engulfing candle is, also look in the top right-hand corner. And I also have another YouTube video breaking down how to be able to properly identify an engulfing candle. So example, right? If you guys actually look at this all the way at the top, this is an engulfing candle. But the thing I want to be able to do is I want to be able to find the biggest engulfing candle on the highest time frame. So I utilize only the 1 hour through the 12-hour time frame. You're usually not going to see me go lower than the 1 hour unless I'm using that information within the bigger time frame, right? So if I find like a 7-hour candle, I might go lower on time frames to see if I can see something within that candle, but the entry is going to be based between the 1 hour and the 12-hour. Okay. So all I'm simply going to do is I'm going to start working my way through these time frames until I find the biggest candle on the biggest time frame. So 2 hour, right? Obviously this candle is a little bigger, right? But we're going to keep going. 3 hour, right? You have this extremely long candle. What I want to have is I want to have a big body candle. This is just a long candle. It's not necessarily a big body candle like this one. So I'm gonna go to the 4, right? No engulfing candle here. Go to the 5, right? Okay. Got a pretty significant engulfing candle on a 5 hour, as you guys can see identified right here. Pretty significant bearish engulfing candle, right? But I'm gonna keep going. The 6, no candle. The 7, the biggest candle. So what I ended up settling on was the 7-hour time frame, which ultimately had the biggest engulfing candle on the highest time frame. Now, once I'm able to find an engulfing candle, right? Keep in mind, if I'm not able to find one, I cannot take a trade. So I then would like to be able to take the 50% of this, which is going to be the Fibonacci is just a custom setting. Okay, so the 50% is going to be good to be able to take advantage of identifying, okay, where's the equilibrium? Where's the sweet spot? Where is a good spot to look for the market to give you a retracement to? So ultimately, I would like to see in the best case scenario, you'd possibly like to see the market retrace to this 50%, right? Which is identified right here before the market gives you, basically that continuation. Now, one thing I want to make you guys aware of is the market is not always going to give you a pullback deep enough to reach the 50%. So if you're only looking to enter from that area, it's kind of ironic because obviously my entry is there, but it's being based off of something. So, basically the market is not always going to pull back that deep. So you want to always be aware that sometimes you might have to have an entry that's a little higher on the candle because you might miss the whole setup altogether if the 50% does not get achieved, right? So for me, right, what I ended up discovering, okay, is there's actually another ability for me to be able to take advantage, right, of, there's another ability for me, my bad, I'm over here I'm trying to look at this setup real quick. Okay, cool. So I'm actually going to let this play out. All right, cool. So I'm going to stop it right there, right? So notice how the market ended up dropping. And as I said, we would like to see a retracement. Okay, so we want to be able to see that retracement to possibly get a continuation, right? So what I ended up doing was I ended up pulling out my other fib. Okay, so I can actually change this back to the fib that most of you are going to be more familiar with, which is this one that has, the 61.8, 71, 78.6, 88.6. So that was a fib I actually took out. And as you guys can see, simply put, whenever you're looking for a sell, you're going to take it from the high to the low. If you're looking for a buy, you're going to take it from the low to the high, right? So from the high to the low, and then basically within this 88 to 61% zone, that's where I would like the market to pull back in general. But if I'm going to refine it, I specifically would like to see the market retrace back to this specific area of this candle, which is going to be identified by the opening and the 50%. Now, the thing I like to be able to teach people is you want to be able to utilize the fib in this manner, okay? So whenever you're taking advantage of the Fibonacci, this zone that I've essentially created, you can use it in one of two ways. If you're a person that likes to be able to execute by market, you could essentially wait for the market to get back into the zone. You can wait to get a rejection, some type of doji candle or whatever you look to enter. And then whenever you get that, you can take the trade. I'm pretty lazy. I don't want to have to sit here on a chart, wait for a rejection, possibly miss out on good sleep. So I want to be able to set a pending order, buy limit or sell limit, which basically, if you look at my chat, I'm not going to say I never do a market execution, but it's extremely rare. It's basically always going to be buy limit, sell limit. So what I want to utilize is within this entry zone, I want to use the fib levels, only assuming that there are fib levels within the entry zone. So if you guys notice, we have two different fib levels, right? The 61.8 is out of the question because it is not in our entry zone. So we got the 71%, right? We also got the 78.6, which is damn near exactly at the 50%. So some of you might be trying to wonder, okay, because if you watch some of my previous videos, what I normally teach is I usually want to go with the fib level that's lower on a bearish candle and higher on a bullish candle, because as I keep repeating, it's not guaranteed the market is going to pull back all the way to the 50%. Now, what I ended up finding out was this ended up giving me a stop loss that was bigger than what I normally look for. So the stop loss that I normally look for maximum is 40 pips. Okay. So the way that I do it is if my stop loss is over 40 pips, I'm simply then going to move my entry to the next closest fib level. So in the grand scheme of things, that's how I was able to come to this fib level, right? That's the benefit of the fibs, right? And if that one was too big, I can move it to the 88. So it's kind of like so on and so forth. And that's how you guys can take advantage of utilizing the Fibonacci retracement, okay? So with that being said, ultimately, what ended up happening was, let me show you guys, right? So ultimately, so one of the things I want to show you guys is for the people that wait for the rejection, this candle would have dipped in. You then possibly could have gotten a trade, but it still would have pulled back. Now, this is why I say I usually don't manually exit. A lot of people, whenever they would have seen this, would have freaked out because in your head, it's like, oh man, it's probably finna just go hit stop loss, right? That's what your brain is thinking, but it's a reason why you have a stop loss. It's there to protect you. The stop loss is there to protect you, there to protect you. So I just want you guys to see this play out, right? So it never technically hit stop loss. The market literally was ranging over the course of 2 weeks, okay? Look at this, literally just ranging, pulling back, going back, and then bam, we finally got it, okay? It finally hit take profit, but let's see how long from entry to take profit you would have been holding this trade. So from entry to take profit, ladies and gentlemen, you would have been holding this trade exactly 14 days, exactly 2 weeks. Now, I know most people that trade in the market are not swing traders. They're usually scalpers or day traders. So it's pretty far-fetched to think that the average person would have held this past 2 to 3 days, especially seeing that the market goes in profit, goes in drawdown, goes in profit, goes in drawdown, goes deep in profit, comes back to break even, then goes back deep in profit. But what I'm saying is the only reason why I manually exited the trade was because it was Christmas. But now I realize that I'm so confident in my setups and I'm usually right a good amount of times that I have to disregard news, right? I don't trade based off of news. I don't trade based off the DXY. I don't trade based off of holidays. I trade based off of what I see. And I'm also just going to hold the trade until it proves me right or proves me wrong. So this was an example that I actually learned from. It was a profitable setup that I would have been holding for 2 weeks and it would have been annoying seeing it go in and out of profit. But at the end of the day, you set a stop loss to protect you. If the stop loss never got hit, but you got out of the trade yourself, you basically assume that you were going to be wrong and you didn't allow the market to tell you that you were wrong. So one of the things I learned from one of my mentors is allow the market to show that you are wrong. If not, stay in the trade. So all in all, ladies and gentlemen, this was an example that I want to be able to show you guys, right? Because ultimately the market ended up, as you can see, it ended up hitting TP1 and then pulling all the way back to break even. But this would have been right, a 2 to 1 risk to reward ratio, which is nothing to laugh at. Now, with that being said, guys, if you're able to come to the video, learn something from the video, appreciate the video, go ahead and hit that subscribe button, man, because I know y'all appreciate it, but you got to let YouTube know that you appreciate it, right? And then underneath the subscribe button, you're going to see the thumbs up. You're going to see the like button. Go ahead and leave a comment. And as usual, right, you guys know the motto. I'm going to see you at the top, not from the top, because the bottom is way too crowded. See you won't want to be a peace.